Okay, everybody, here we go. It's me, Gregory Mannarino. Monday, May 20th, 2024. Pre-market report. People sit back and relax because things are kind of playing out in a very particular way. And I want to talk about that because it's going to impact every single one of us. Let's start off with the market so I can get my head on straight. So stock futures this morning are ever so slightly higher. But a phenomenon is occurring and we need to pay attention to this. The MMRI has gone up lately. That means risk is rising. You got the 10-year yield higher, the dollar this morning higher on a relative strength basis. Maybe it has something to do with the death of this Iranian, whatever the freak he was, thing over there. They're all things here in the United States too. I'm not pointing at anyone in particular. But the market's unhappy about what may come out of this. And that's something that we need to talk about too. But hold that thought real quick. So as I said, you got stock futures slightly higher, Bitcoin higher, cryptos higher. You got gold and silver higher. You got crude oil this morning under a little pressure, but still hovering where it's been around $80 a barrel. That's going to change, and it's going to change probably rapidly and very soon. Let's talk about that in a moment as well. So that's the story this morning for the setup for the market. Now, with regard to this is a game that the Federal Reserve is playing with us again, and it bothers me to the highest order. So Fed Bostic, this thing, got floated out this morning. I don't know how many of you caught him. I think I was flipping through Bloomberg at the time. So look at the wording here. Okay, Fed Bostic expects inflation to keep coming down. Now understand, this is a lie on its face. Okay, inflation is not coming down at all. Inflation continues to rise. But this is the lie that's being sold to people right now. And I don't know how many people are buying it. I know it's not you. But inflation is not coming down by their own numbers. Inflation continues to rise. Now, I want you to keep that in mind. Although he does admit here that the economy is slowing down. Economy is slowing down. You see that? Anyway, you and I have discussed multiple times the issue with regard to the money velocity or the rate at which cash moves through an economy. Here we have an admission that the economy is slowing down by Bostic. You see that right there? Economy is slowing down. All right. Now, in times of a booming economy, you would expect to see the rate at which cash moves through an economy pick up. Does that make sense to you? Cash is, a lot of transactions going on. So cash is obviously going to start moving. In an environment where the global economy today is slowing down at its fastest pace ever, we've never seen this before. We have the rate at which money or cash is moving through the economy, the money velocity here, spiking. Do you see this move here? Higher, 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 higher. That's off the Federal Reserve's own website. This is 1 year only, all right? But you can see the trend. Higher, 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 higher. You got that? This is occurring, again, at a time where, don't take Greg Mannarino's word for it, listen to Bostic. The economy is slowing down. Whoa, there you go. The economy is slowing down. All right, we all know the economy is not just slowing down. We're at a standstill here. And the issue with this, the money velocity, this is troubling because, again, the situation is very simple to understand. Central banks collectively have been inflating the global debt on a scale we've never seen before. They're continuing to do so right now. Debts and deficits ballooning out of control. So now we have a situation where all those extra bills are now starting to chase the same amount of goods, or in this case, a lesser amount of goods. This is why this is happening. I warned that this would happen from at least 5 years ago. Now we're starting to see this now. This means that the price of everything is about to get much worse, much higher. So this whole nonsensical inflation, slowing down, which he's not the only guy. They're floating out several Fed presidents to tell you the same thing. It's not true. Inflation continues to rise. It's going to continue to rise much higher. But there's something else going on here that we need to talk about. Again, as I started this video off, things are lining up in a particular way. I'm an analyst. You all know that. I'm a macro analyst. This is what I do. I look at the market. I look at everything that can possibly play on the market. I put it together, again, filling in some gaps in on my own. This is a game we're playing of incomplete information, and the data is always changing. But what we do know, with regard to inflation, it's not going to stop. Money velocity is telling us right now, no matter what comes out of the mouths of Fed presidents or anyone else, this is how they've set it up. And we also understand that the Fed is inflating the money supply on an epic scale. 418 billion. It's more than that now because this is lagging since the end of February. Okay, so they're continuing to inflate. War is expanding. Now, the setup for the market appears to me, and I was writing this down here, I'm expecting to see a spike here with regard to energy prices, and it could be profound across the board. And all those costs are going to be passed on to you. Again, understand how important energy is to the world, to the markets here. And again, it will cost more to ship things, just at its most basic level here, to you from wherever they're coming from. That takes energy. Those costs are going to be passed on to you, on top of the money velocity rising, on top of the fact that the Federal Reserve in this case is pumping the money supply in an effort all just to keep the market propped up. The illusion of the market. Sound familiar? I've only talked about this about 1,000 times. So I want you to understand this. So this, I think, is something we really need to pay attention to. Now, my lions out here, you want to get long energy. You want to get long commodities, crude oil. You know that. I've been telling you this. But I think big energy, if you want to pick an energy ETF, look at XLE. You want to, look, I'm going to get myself in trouble with this. This is how I got myself in trouble last time with the SEC. 2 times, okay? By throwing stuff out. They're coming after me. They don't come after, I don't know, anybody else. But they come after Greg Mannarino, which is just frankly ridiculous. Anyway, so watch for a spike in energy. I would imagine this could happen very, very soon, and it could be extremely profound. Your life is about to get much harder. So start taking action, betting against the debt, becoming your own central bank. Take advantage of this kind of information. This is actionable stuff that I'm putting out here for you. Now, we got the Bank of England here. They're floating out their freaks, talking about rate cuts coming and could be soon. So expect that as well. People, this one last thing I want to cover with you, and I think this is critical. I've been talking about a Dow-gold ratio of 1-to-1 for about 10 years, okay? Of course, I've been laughed at, I've been ridiculed, and everything. Well, people don't understand, people who say those kinds of things. This happened before. Maybe not exactly on a 1-to-1, but we've gotten pretty close before in the past. And I want to talk about this just real quick so you can understand my perspective. If you do subscribe to my free newsletter, this is in your inbox right now. Right now. I urge you to read through this, okay? Dow-gold ratio and stock market crashes. Not only read through this, people, if it's hard to understand, read through it twice, whatever it might be. Ask me some questions about it. I'll try to get to them in the live stream later today. Share this stuff. Please get it out there. This is how you and I can make a difference in the world, by waking people up. You're not going to get this kind of information anywhere. I'm going to tell you right now. So, again, and this is free stuff. I know this stuff, obviously. This is for you guys and girls. You understand? And I'm trying my hardest to, explain these things to you. So let me read through this real quick. Bear with me. And I think this is going to, at least hopefully, spread a little light on why I believe we are going to achieve a 1-to-1 ratio with regard to the Dow-gold. Right now it's about 17. And think about that number as I read through this. So Dow-gold ratio and stock market crashes by yours truly here. And I start off with Lions and Friends. Please share this article. I'm counting on you to do that. So let's start off with what we already know. All right, cash moves through the markets in predictable patterns, and central bank monetary policy is solely responsible for driving cash either into or out of certain assets. Central bank monetary policy is the number one driver of the markets, period. We've already spoken about how PE ratio, forward guidance, earnings, they almost have no effect on the market anymore. It's about easy money. It's about the Fed put, which is now in place. China's dumping debt, U.S. debt at record amounts. We've never seen anything like it before. Who's buying it all? If there is a seller, there has to be a buyer. Otherwise, we would see rates spiking here at an uncontrolled pace. It's going to happen. So bond yields coming down, that's the Fed buying the debt. As an example, After the stock market meltdown / financial crisis of 2008, the Federal Reserve implemented what has become known as quantitative easing. Quantitative easing is defined as the introduction of new money into the money supply by a central bank. Duh, we all know that. The QE process involves vast purchases of debt by a central bank, in this case the Federal Reserve, and massive issuance of debt, the currency itself being units of debt. You understand where I'm going with this? Quantitative easing initiates a revolving door mechanism. I've spoken about this many times, by which a central bank issues debt through one door and then buys it back through another door. This is massively inflationary. At its core, quantitative easing allows a central bank to vastly inflate the overall debt, which is of course their overall goal. The more debt a central bank issues, the stronger they become, not the weaker. Okay, I'm only stressing that because, again, during Trump's last administration, there was a lot of talk out here how Trump is trying to bankrupt the Fed. That's why he's spending so much. No, the truth is he was spending so much to empower the Fed. They're all in the same game. No one works for you. No one has your best interest in mind except you. You and me and the rest of us in this worldwide family that belong to this blog. So understand, you're going to be sold propaganda. You were being sold propaganda then. The more debt a central bank is called on to issue or can issue, the stronger they become. Quantitative easing then, via this mechanism, artificially pushes bond yields lower. Okay, pretty easy to understand. And this in turn opens up a doorway for cash to make its way into risk assets or the stock market, therefore inflating stock market bubbles. Quantitative easing hyperinflates the money supply / overall debt, which is massively currency purchasing power negative. Make sense to you? You dilute the currency. With that, it is only a matter of time before all those extra bills, in whatever form they exist, start to chase the same amount of goods. And this is why we're seeing the money velocity pick up. Is it starting to click? I hope so. Alrighty. The result is inflation, like we have now, and massive price action distortions across the spectrum of asset classes. And I think energy is about to spike, people, so just keep that in mind. Energy prices, your cost of living. Quantitative easing is responsible for inflating stock market and real estate bubbles. Pretty obvious. QE is also responsible for creating inverse bubbles as well. You know this if you follow this blog. When a central bank initiates QE, and this is the Fed put as well, which we're seeing, cash is pulled from other assets, more specifically commodities. You all know that, resulting in enormous undervaluing of these assets. This undervaluing of assets creates opportunity, people. This is what this channel is all about, to buy commodities on sale or at a huge discount. Does this make sense to you so far? Here we go. Understanding that QE / easy money policies, suppressed rates, currency devaluation drive cash either into or out of certain assets, we can look at gold. Okay, or more specifically the Dow-gold ratio, which is what this is all about here, people. The Dow-gold ratio in stock market crashes, okay? To gauge how extreme these central bank-induced price action distortions are. Just prior to the stock market crash of 1929, which led to the Great Depression, the Dow-gold ratio peaked at around 18. Today, we're at about 17. Meaning that it took 18 ounces of gold to equal the Dow. During the Great Depression, the Dow-gold ratio fell to 1.59. Those of you that were laughing at me in the past, yes, this has happened before, and it's going to happen again. Meaning it took only 1.5 ounces of gold to equal the Dow. In 1980, the Dow-gold ratio fell to 1.35. Here we go. Just prior to the dot-com market crash, the Dow ratio was 42, the highest on record, and subsequently fell to 6.7. Today, the Dow-gold ratio sits at 17, very close to where it was prior to the 29 stock market crash. Now, I wrote below is a chart, a long-term chart of the Dow-gold ratio. Now, again, this is in your inbox. There's the chart that shows you what I'm talking about here. The times where we've seen spikes and, dips. Today, the distortions which exist in the market are at extreme levels. Never in history have we seen a larger debt market hyperbubble. We haven't seen anything close. With that, and in my professional opinion, we will again see a Dow-gold ratio drop substantially. In fact, I believe we will see a 1-to-1 with gold. Does this make sense to you people? I hope so. Again, I can't imagine where you're going to get a piece of information like this, especially for free. It's in my newsletter right now. People, subscribe to my newsletter. If you don't, you're going to miss out on stuff like this. And please share this. I need all of you to help me get this information out. I'm counting on you to do that. All right. So this is critical stuff. It's gold. It's gold, in my opinion. All right. So with that said, people, let's sum this up. In my professional opinion, it appears that we are being set up. Vastly expanding war, much more spending. We are going to see inflation get out of control. Money velocity picking up. Okay, inflation is not dropping like this guy wants you to believe. Expects inflation to keep coming down. The wording is key. It's a brainwash. It's a psyop. It's another lie. There's no accountability here. Get yourself on the right side of this, people. It's all about commodities. You need exposure to commodities. Energy, for my lions out here, I don't believe I need to say more than that. Look at big energy companies here. Crude oil, obviously. People, I got your back, and I'm trying my hardest here. All right, really, to make this understandable for you and easy to understand. Please share this video. Please get it out there. All right, don't know another way to ask you other than saying please here. You got something out of this video? Makes sense to you what I'm talking about? This makes sense to you what I wrote? Please give this video a thumbs up as well. I am counting on you for that. If you're part of my team, it's required. All right. I love all of you from the heart. I mean that. I will see all of you later, 4:05 p.m. Eastern for my live stream. I really hope to see some of you there and have some questions for me. If you read through this and you have questions, let's cover it later. This is why I do the live stream. You understand? I love being with all you guys and girls as well. Anyway, until I see you later, take care of yourselves and take care of each other, okay?